Good evening. Dan Fitzpatrick here at StockMarketMentor.com on Wednesday, iPad day, Wednesday, March 7th. Look, I'm not going to talk about Apple here. I've been talking about it enough in the chart of the day. I'll have some things in the strategy session, but I do want to talk about semiconductors. We're going to go through a few of them. And what I'm talking about here is not like, ooh, buy this, buy that. Though every stock that I talk about here, including the SMH here, and there are going to be 5 of them real quick, I think you could buy. What I'm talking about is framing your risk versus your reward. And this is how it works. Before you can frame your risk versus your reward, you got to figure out where the risk is and, of course, how much the reward might be. This is how you do it. It's pretty easy. Okay, where's support? Here, we got our support yesterday. On yesterday's sell-off, or I should say kind of a little bit of a bounce. It was the end of a multi-day sell-off that ultimately bounced at the 50-day moving average. That gives us support. It gives us, like for right here, right now, the maximum power of sellers. So we put a stop, let's say we put a stop at 32.80. We're buying the SMH at 33.84. We'll call it, hey, make it a buck, okay? We'll use the extra 6 cents as a rounding error or something. But so we've got $1 risk. That's the risk. Now we look at the reward. Well, where's the resistance? Is the resistance up here? No. That used to be resistance. Now you've got all these folks that had bought at support, hence that's why they bought. You extrapolate that around, and there's your resistance right here, because right in here is Helga's House of Pain. This is where supply lurks. So what I'm saying is, if we just have to say, okay, stock's going to stop at resistance, it's going to bounce at support, then we're saying stock's going to stop right there, it's going to come back down, and it's going to bounce. You can't say that, though. What you have to do is look at this and say, okay, I see where supply is. We got a nice bounce here. Let me do this. I at least know what my risk is. Now, I can trade this stock, but I know that any climb into this red zone here is going to be picking up extra supply. So I need to watch extra close and see what the stock does at that time. What I'm not saying is don't buy this stock because there's not enough reward in it. No, what I'm doing is saying this is how you make an assessment for how long you're gonna hold a stock if you do buy it. If the stock comes up another buck or so and then starts to roll over, well, you know what? You take your money and run. You do the Steve Miller trade. As long as it keeps going, you keep holding on, because I'll tell you this. A lot of times you get these, let's say this is a volatility squeeze. A lot of times you're going to get these resolutions this way that turn out to be fake outs. And the stock just keeps going. That could be the case here, but what I'm saying is let's just frame our expectations and look for this kind of move, and anything above that is all just kind of gravy, but it might be kind of tough gravy to get through. Okay, so let's go through a couple of these in the sector. Qualcomm, you can see the bounce. Now here it's a little different. I actually like this because for one thing it was a little bit more of a gentle move down. I just don't sense this is as much resistance as the other one. Qualcomm though, you buy with your stop below yesterday's intraday low of 60.93, make it 60.80, whatever. Now you've got effectively like what? $3, $2, sorry, bad mental math. So the bottom line is you know what your risk is. Now you're looking for your reward. The only way you would be buying Qualcomm right here is if you think it's going to break out. That's fine. You go ahead and make that trade. If it halts right here, doesn't, and it starts moving lower, take your money, take it off the table, and by the way, you can always buy it back if it ultimately does break out. I'm talking here about how you frame your trades, how you get into a trade. Okay, linear tech here. Looks a little bit like the SMH, doesn't it? Here's your resistance right up here. There's all that excess supply. Support right here. You keep your stop right below there. If the stock gets into the gray zone here, excuse me, the red zone here, then you look for excess supply. If it keeps chewing through it, that indicates a really strong demand for the stock. Look for this kind of move. If it wallows, then sell it and get out. Take your money. The last thing here is Intel. Now, Intel's interesting. It's just been in congestion. It's been in sideways congestion for quite a while. Okay, that's a good thing. It's healthy. What it does, it makes me kind of want to buy the stock, frankly, because support's right at the 50-day moving average. You keep your stop just below that. You see what happens. Wait for the breakout, but you keep your stop here. As long as you have a stop in place, and as the stock moves sideways, if the 50-day moving average slides upward, then slide your stop upward. You're lowering your risk while still staying in the trade. Then if the stock does break out, bam, you're in the trade early, you're making money. Anyway, those are just some thoughts on semiconductors, but I think if you really think about what I'm saying, you're going to be able to apply that tactic, that strategy, frankly, to any of your trades, okay? Members, get over to the strategy session now. I got a couple other sectors I want to talk to you about.